All right, we're recording. Thank you for reminding me. Not much. We haven't really covered much. All right, we're just trying to make a decision. All right, between two options. We're using differential analysis. All right, we're looking at differential revenues, the difference between your two options, differential costs, the difference between your two options, and then differential revenue subtract differential costs gives you differential income. And so the criteria in this case, if positive, all right, then choose option A. Okay. And so what I'm trying to do is find a problem that has both revenues and costs, because not all of them do, all right? Some of them have just components, all right? So maybe you're just looking at cost component or not, all right? And so let's see, process, bottleneck. Let's go ahead and we're going to work through PE 25 to A. Okay. And this one, it's the discontinue of a segment, all right? And so with this one, it's kind of an interesting component, all right? When we're talking about the discontinuing a segment, we're talking about a conglomerate, all right, or a company that has multiple products, okay? And so in this case, the problem reads, product alpha, okay, has revenues of $545,000, has variable costs of $400,000. It has selling expenses of 65, fixed costs of 90, creating a loss from operations of $10,000. All right, and so this product that we're making, all right, is losing us $10,000. And so this one is basically looking at, should you do or should you not do? Should you do product A and currently you're losing $10,000, right? Or should you not do product A or alpha, I should say. And so it's do, don't do. And so what I'm going to do, kind of repetitious there, is I'm going to make option A, we're going to do it. Okay. And then option B is don't do it. Okay. And so in this scenario, okay, we have to be able to identify several things, right? We need to be able to identify relevant costs and irrelevant costs, right? Or relevant items and irrelevant items. Okay. And so the first thing that we're going to do is we're going to look at this and say, hey, if we do this, okay, we're going to have revenues, right, of $545,000. Okay. And so we're going to have 545. Okay. If we don't do this, okay, we're going to end up with zero revenues from, because we're not doing product. So the differential revenue here is 545. There's really no question here of identifying relevant, right? That is relevant, okay? Revenues are relevant. If we do it, all right, we're going to get, $545,000. If we don't, we're not going to get anything, right? Okay. However, identifying the relevant costs, okay, versus the irrelevant costs, right, below here, we have this, right? And so it told us that we had variable selling expenses of 65. So if we do this, we're going to incur, all right, $65,000. All right? Okay. We're going to incur $65,000. If we don't do it, it's going to be nothing, right? Okay, it's nothing. If we do this, we're going to have fixed cost of 90,000. If we don't do this, okay, and see, this is what I refer to as an irrelevant cost, because fixed are fixed, right? Okay, if you're understanding of fixed cost, right, fixed are fixed, then it doesn't matter if you make 1 unit, all right, or 0 units. okay, you're going to have to pay that $90,000. That is not relevant, right, in this scenario. Okay. And so, if it's not relevant, do we include it? The answer is no. Right? And so we don't include this here. Right? And so really, this is variable cost, right? This is fixed cost. We're only going to be looking at the variable costs when it comes to discontinuing this segment. Okay, and hopefully you remember. Okay, so we had, you know, differential cost comes out to be 65,000. Okay. And so what does that bring us down to? 480. I better check my math here. 545 subtract 65. Yep, $480,000. Okay. That's our differential income. So it's a positive number. Okay. So we should choose option A. We should do this. Now, I want you to know that when we're looking at differential analysis, we're really only looking at the quantitative components, right, of these decisions. Quantitative really is just the numbers. Quantity, quantitative, all right? We are not taking into account at all the qualitative components of this, all right? So qualitative is the quality of the decision, all right? So just know that, you know, when you're working these problems, you're not taking into what I refer to the touchy-feelies, all right? You know, the benefits from a society perspective and things along that line. All right, we're just looking at the numbers. So in this case, right, and looking at this information, we should continue to do product alpha. Does that make sense to you guys? All right. I do want you to know, because a lot of times they throw in dates. The date really is not an issue at all. Okay, you know, so it says this happened on December 10th. All right, we don't really care. All right, that's just so just don't worry about that, right, when it comes to the problems. Does that make sense? Okay. Now, as long as you knew, okay, things that were relevant versus things that were not relevant, okay, you know, you could have done this without actually, you know, having to make this whole table. You could have said, hey, if we do this, we're going to make 545,000, and really the only relevant cost here was the variable ones, right? Because think about a variable cost. If you do 0, you're going to have 0 cost. But if you do 1,000, you're going to have, you know, let's say $65,000, all right? Because that's variable in nature. And so really another way to look at this, okay, and I talk more about this in the video, is that if this has a positive contribution margin, you do not discontinue. So if you remember what your contribution margin was, right? Contribution margin, contribution margin equals sales subtract your variable cost, right? Okay, and that's what we did here. We had our sales subtract our variable cost. Okay, so as long as this is a positive contribution margin, positive, okay, then you're going to choose option A, and option A was do not discontinue. Does that make sense? I hope so. All right, so let's do a couple more, and then I'll let you guys go. All right, because like I said, a lot of this is common sense. And so let's go ahead and look at PE 25-3, 25-3A. In this one, it says restaurant bakes its own bread for a cost of $320 per unit or 1,000 loaves, okay, including fixed costs of $47,000. A proposal is offered to purchase bread from an outside source for $180 plus $18 per unit for delivery. Okay. Prepare a differential analysis to determine whether the company should make alternative 1 or buy alternative 2. All right. assuming that fixed costs are unaffected by this decision. All right, so it's kind of giving you a little heads up there. All right, and so it's telling us, okay, that we can make our bread, all right, for 230. Okay, so we have total cost make 230. Okay. But because fixed is fixed and it's not relevant in our scenario here, we're going to subtract that $47, aren't we? Okay. And so we have 230, all right, subtract 47. Okay. And so really what we're looking at is we're looking at $183, okay, per batch, right? Whereas if we were to buy this, okay, we're going to have buy. Okay, we're going to have 180 plus $18 because that is relevant. Okay, you know we have to pay. Where did it go? Yeah, we had to pay $18 per batch or per unit. Okay, for delivery, and so this really comes out to be $198. Okay. So which one should you do? That one, of course. And so, like I said, you don't have to necessarily go and fill out that full differential analysis format. Okay. A lot of this you can do easily calculations. Now, I chose this one because there's several things that are different. Okay. This one is not looking, all right, at revenues at all, right? It's only looking at costs. I also chose this one because this one has some definite qualitative components that I just want you to be able to identify. You know, in our decision making, it's not going to change our quantitative calculations, but there's some qualitative things that can happen here. All right. One of the qualitative things, again, that supports the make component, is that if we make it, we have more control over the quality, right, of that bread, don't we? Okay. You know, we can, you know, the bread is, you know, we are the ones who have the input, okay, into making that bread. Whereas if we just buy it from somebody else, we don't, you know. The other thing is how long are they going to offer it to us, you know, for this $198? Okay. You know, they could, you know, do a bait and switch and say, oh yeah, hey, enter into this contract, you know, get you guys to switch to buying it. You sell all your equipment so you can't make it anymore. All right. And then they up the price. All right. And so again, you know, those are qualitative components that come into play. And a lot of times they will trump or overrule the quantitative stuff. Not in this case, all right, but just FYI in the future. Okay. And as a manager, you know, those are questions that you want to be asking yourself. Another one I like to do, okay, is replacing the equipment. So let's look at PE 25-4A. Okay, replacement of equipment. It says in this scenario, it says a machine with a book value of $250,000 has an estimated life of 6 years. A proposal is offered to sell the old equipment, right, for $320 and replace it with new equipment at a cost of $390,000. The new equipment has a 6-year life with no residual value. The new machine would reduce the annual direct labor cost from 75 to 61. Prepare a differential analysis, right? Again, the date is really not important, but on October 3rd, on whether to continue with the old machine, alternative 1, or replace it with the new equipment, alternative 2. All right, and so let me put a little bit more flesh to this. All right, let's say that this is a computer software, all right? And so, and I'm going to add some things. I'm going to say, hey, you know what? A long time ago, okay, we had a historical cost of the old equipment. Okay, let's just say that that was $500,000. Okay, we have the accumulation, right, of the depreciation, okay, of $25,000. $250,000. Or no, I'm sorry, not 25, $250,000. Okay. That gave us a book value, all right, of $250,000. So, this coincides with this replacement problem. It says, hey, we had a machine that had a book value of $250,000. Okay, and so this is you. You're the IT manager. Okay, and you're like, man, I really want to get some new equipment. I saw this stuff. I can go out and buy this new equipment, and how much does it cost? Where I lost that. Okay, we can buy this new equipment for $390,000. All right, and so you go into the office and you talk to the manager or whatever. This not the IT manager. Let me just highlight that. All right, you're talking to the CEO. Okay, so you're walking in the CEO's office and hey, Mr. CEO, I want to buy this new computer system. And he was like, what? We just bought some a few years ago. All right, it happened to be 5 years, straight line depreciation. All right, we just bought this, or actually, sorry, 6 years ago. All right, that would make it straight line. So total life of 12 years. All right, we just bought this stuff. All right, we spent $500,000. How much is this new equipment? All right, and you're like, oh, that's going to cost us. I lost my thought. $390,000. What? Okay, well, okay. How long is this new equipment going to last us? Oh, it's going to last us 6 years. Well, what about the old stuff? What about that old equipment? How long is that going to last? Oh, 6 years. What? Get out of my office, man. What are you thinking? All right, you want me to drop another $390,000? All right, when we have some equipment that's just working fine. All right. Well, he doesn't have the full picture, and you haven't done a very good job in laying it all out. All right, because if you use differential analysis, it's possible, okay, that it would be worth your while. All right, and so let's look at this. Let's look at the things. So is this relevant? All right, is this $250,000? Is that relevant? Okay, the answer is no. All right, it is not relevant. This is what's referred to as a sunk cost. All right, the value of that old equipment is not relevant anymore. Okay, it has gone the way. All right, we've already spent that. It's not like, are we trying to decide should we buy that old equipment? No, we already bought that old equipment. All right, so that's not relevant in this decision. Okay? But it told us that we could actually sell this. Where'd it go? Okay. A proposal is to sell the old equipment, right, for $320. Right, and so is that relevant? Right? Is the $320,000 sales price relevant? Okay. The answer is yes. Yeah, that's relevant. Okay, because really that's going to offset the cost of the new stuff, isn't it? Okay. Yes. That is relevant. Okay. Is the price of the 390, is that relevant? Yes, that is relevant. All right, because in reality, we're only going to have to spend, all right, $50,000. Right? No, $70,000 to get this new stuff. All right, this is the well, it's not really differential revenue or differential cost. Okay, it's the net cost. Really, where the big difference, all right, comes is the differences between the annual direct labor cost. Okay? Because if we buy that new one, right, it has a faster processor. Okay? If it has a faster processor, that's going to save us time, right? Time is money. direct labor to be specific, all right? And so we have a difference here. We have 75,000 under the old and 61,000 under the new. And so we're going to be saving us $9,000. I'm sorry. No, $14,000. All right, that's going to give us $14,000 in savings. Good thing I did my math with my calculator, not my head. All right, and this is for 6 years. All right, so we're going to have a cost savings of $84,000. Okay. And so, you know, if we offset that increase, right, of the 70,000, we're going to have $14,000 benefit, okay, for replacing. Okay. So we should go ahead and replace that. Questions about that? All right. Well, let's do one more, okay? Because these ones have, I've chosen these because they have specific components that I wanted to kind of highlight. There's the aspect of a sunk cost, all right? By the way, the sunk cost in this scenario is not the historical cost, it's the book value, all right? And so that's what is referred to, because I think there's a multiple choice question that says, hey, what are the sunk costs? And it gives you the old cost, the historical cost of 500. It gives you the accumulated depreciation. Let's just say it was 300. And so in that scenario, your sunk cost would be the 200,000, right? And then, you know, just being able to identify what was relevant and what was not, right, is also one of the considerations. However, if we look at PE 25-6A, that's the last one we're going to work here. And this is accepting business at a special price. When we are considering this, there's two variables that have to be in play. The first one is that we have sufficient capacity, all right? Which means, you know, with our current capacity, we could actually produce, all right, this special price offer. The other thing is that it does not impact our domestic or our other sales, all right? And so in reading this, it says product AA normally sells for $120 per unit. Okay. A special price of $112 is being offered to the export market, all right? The variable production cost is $80, and an additional export tariff of 30% of revenues must be paid for all export products, assuming that there is sufficient capacity for the order. Prepare a differential analysis dated March 5th, whether to reject alternative 1 or accept alternative 2 of the special order. Okay, and so all right, so I'm just reading. All right, and so they're asking, they're not even asking, this isn't really what I was hoping to get. All right, but in this scenario, okay, is the 120, is that relevant? All right, that's our normal selling price. The answer is no, okay, because really what we're looking at here is the special price, which is 112. And then the variable costs, because really what I was hoping that they would show us, in this scenario that I put on the video, we have variable and fixed. In this scenario, would fixed be a relevant cost? The answer is no. Because fixed is fixed, whether we accept this or reject it, it doesn't really come into play, all right? But we want to see what the additional costs. So we have our variable costs, okay, which were $80. And we have that additional export tariff of 30%. Okay, and so export okay. We're going to take the 112 times 30%. Gives us $33.20. Recalculate that. And so, looking like we're not going to do this, is it? So, this comes out to be 113.60, and we only have revenues. Okay, we'd actually lose 140. No, 160. Do not accept this deal. All right. You'd actually lose money by taking this deal. But let's say it was acceptable. All right. With this, two things have to be into play. First of all, you have the capacity, and per this problem, it said you did have, it said you had sufficient capacity to produce this special order. And it didn't say anything to this, but probably because we're going to reject it anyways. It can't have an impact on your domestic sales because, the people that you're currently selling it to, you're charging them 120. Okay. It's not relevant in our quantitative calculations, but it is for our qualitative. If people find out that we're selling our product for 112, okay, our normal customers are going to be upset, and they're going to demand that you sell to them for 112, right? Which completely destroys this company as far as the profitability. So in this case, not only are you going to reject it because of the qualitative component, we're also going to reject it because of the quantitative, right? Because the numbers just don't make sense either. All right. Cool. Well, that's pretty much all I have for that I plan to do as it relates to the differential analysis. Like I said, a lot of it's real common sense. Right? I've got all this content. I've got this saved already on the Moodle page. So let me